Hey guys, welcome back to the channel. On today's video, I'm going to show you a sample US-based dividend portfolio that's going to pay you $108 a month in dividends. The investment that is required is $50,000. I chose this amount because it's an amount that an average person can save in their lifetime. This is a realistic portfolio, it's a realistic goal for people. And $108 a month isn't life-changing, but over time it will grow. So it's something to be excited about, it's something to feel good about. On my Canadian video, we were very concentrated with the sectors because the Canadian market is very concentrated versus the US market. There is a ton of choice. It took me a long time to compile this list of stocks. I'm going to go over all of them and why I think they're a good buy here. But first I'd like to say to like and subscribe if you like this kind of content, and I'll make some more of it. First, I want to go over their sector allocation because we're not going to put all of our money into one sector. It's not all going into tech. That's a terrible idea. We want to diversify ourselves so we diversify the risk. Alright, so the different sectors we're investing in for the sake of this portfolio are consumer. This will include both discretionary and staple, fintech, technology, banking, healthcare, oil and gas, and telecommunication. I want to point something out here, and that's the total yield. The average yield here is very low it's only 2.64%, which is significantly less than the Canadian portfolio that I just showed you last week. But this goes again back to, there's a big difference in the markets. Now, let's look at the technology sector, for example. The couple stocks that I picked, which happen to be Microsoft and Apple, if you average out their yield, it's only 0.72%. Not very high, but to be honest with you, they have the ability to raise this dividend a lot over time. And not only that, you're going to get capital appreciation. So it's not just we're not focusing mainly on yield here. We want good growth. We want everything. We want it to be well-rounded. So I want to go over the companies one by one quickly here, guys. The first one is in the banking sector. It's JP Morgan Chase, okay? Now, the reason this one is here is because, in my opinion, it is the absolute top of the American banking system. I love their management. Their CEO has talked about investing into fintech, and fintech is the future. They're currently making a payment system to compete with Square. I love it. It's fantastic. So the yield today is 2.31% at time of making the video. This is not huge, but the Feds just said that the American banks can start raising their dividends and commence share buybacks again. So look for these things to go up in the future. The second company is Pepsi. Everyone has heard of Pepsi. They make all the soft drinks you love and some of the ones you hate, okay? Now, the current yield is 2.88%. Some of you might be wondering, why did you not include Coke? Well, I don't want to offend anyone, but as of late, Pepsi's been doing a lot better, and Coke has kind of been seeing a decline. So I'm liking the direction Pepsi's going. They got a lot of money invested into the snack market as well. And they're just doing a lot better than Coke right now, and that's why I decided to choose them. But Coke's fine, to be honest with you guys. I think Pepsi has better growth in the future, though. I've included Procter & Gamble. It's kind of a boring one, to be honest with you. The yield is at 2.55%, but they have so many brands. They have so many iconic brands that everyone's purchasing. I mean, when you go to buy toothpaste, are you going to buy the no-name toothpaste to save 25 cents? I think your teeth are worth more than that. You're going to pay up for their brand. So it's a good one to have. Don't expect the stock to jump or anything like that, but it's a good steady eddy and a good cornerstone in your portfolio. The next stock we have is McDonald's at a yield of 2.21%, which is, it's okay. It's on the lower end, but this gives us really interesting exposure to both real estate and the fast food industry. I like this stock. I think McDonald's is always changing to evolve with the times. I don't know if you guys have noticed, but like every 5 or 10 years, they completely redo the inside of McDonald's. They give it a new look, a new feel. They're always evolving the menu. This is something that I love over time. If they can evolve and stay relevant over a long period of time, that means the dividend can evolve and grow. So I love it. This is a fantastic hold. The next stock is a fintech stock. It's Visa. This is, well, I mean, you've heard of Visa. You could have put MasterCard in here too. They're kind of interchangeable, to be honest with you. The yield is super low at 0.54%. This is going to be a capital appreciation stock, but they do have a lot of room to raise that dividend. And honestly, guys, the two main players, Visa and MasterCard, the third biggest player is Amex, and they're not even close. These guys are not going anywhere ever. This is an absolute beast of a stock to own for the long term, for your whole lifetime. I love it. The next one is our first healthcare sector stock. It's AbbVie. The yield is pretty good here, guys, at 4.51%. This is a really cool company. They own the patents for Botox. The thing with this healthcare company is, well, the same with all healthcare companies. They work on a patent-based system. So whenever the patents fall off, that means the rest of the market can start making the knockoff brand and just name it something else and sell it for a lot cheaper. So this is a problem. If you know the blue pill Viagra, okay, well now everyone's making a blue pill because the Viagra lost their patent, so everyone's allowed to make it the same chemicals and sell it the same drug. So, you know, their parent company took a hit on that. Okay, so AbbVie's going to deal with this when their patents wear off. They have to purchase new drugs. They always have to be innovating. You need to keep an eye on your healthcare stocks for this reason. They're always going to lose patents. They're always going to need to invest in new products. So if you're going to own something like this, you need to keep your eye on it, but it can be a great hold. The next company is Exxon Mobil. So I know a lot of people don't like to invest in the oil and gas industry. So if you have an ethical problem with it, I mean, just don't. Just replace this with something else. I don't have a problem with it. I think it's useful for our civilization at this point in time, so I'm okay with it. And the yield is good at 5.51%, and it's an absolute money-making beast. The price of oil has just been skyrocketing lately too, but there's ups and downs in that. Anyways, this is a good long-term hold in my opinion. And the next one is Microsoft. I think you've heard of this. Microsoft has been on an absolute tear. The yield is, you know, almost nothing here at 0.81%. But here's the thing. These companies, these tech companies, Apple, Microsoft, Amazon, I think one day they're going to be dividend aristocrats. They're going to just be, if you invest today, in 20 years, you're going to be getting a huge, huge percent, guys, all right? Even if it's not like that today, you need to be forward-looking on these types of things. The reason why I want Apple included, the yield's only 0.63%, but you know what? The branding is so strong on Apple, people will take a bullet for Apple. That's how much they love it. This is a huge, huge company. They just started making their own chips right now, so they don't need to use the AMDs. They don't need to use the Intels. No, they have their own chips. They're getting the middleman out of there. They're taking more profit, and they're always innovating. This is a hold for life, even though the yield is low. And the last company on the list is Verizon. I wanted to put AT&T in, but after the merger with Discovery, there's a lot of balls up in the air right now. This is just a steady Eddie, paying 4.5%. This is going to increase our average yield. It's a good company. I just wanted exposure to this space right now. After the dust settles on the AT&T Verizon deal, it might be better to invest in AT&T, but we need to wait and see right now. Now, I told you guys before we're going to invest $50,000, so I did it evenly, just $5,000 into each of these stocks, and that's how we're getting our $1,320 a year or $108 per month. And I just made a little graph here to show you the yearly income by the company, and it's going to vary widely. Like I said, we put $5,000 into each and every company, but you'll see here Microsoft is only giving us 3% of our income while Exxon's giving us 20%, right? So that has to do with the yield there, guys. There's a big difference between their dividends. And that's all there is to it. So, you know, the yearly income by company is not super important. These are great, great companies, and they all contribute to your overall portfolio. Getting $108 a month is fantastic. It's going to set you up. If you keep reinvesting those dividends, in 20 years, it's going to be a lot more. These companies are going to continue to grow and do better and better and make more profits for you. So this is a portfolio that you can feel good and sleep well at night with. I hope you like this video, guys. Let me know what you want to see in the future. All the best and good luck investing.